Hey everyone, Justin Walsh here, branch manager with Franklin Direct. This video is specifically for business owners when it comes to home financing and knowing what your options are as a business owner. This is a very sticky topic. There's not a lot of education out there. I don't see a lot of videos on this topic, but many business owners are unfamiliar with what their options truly are, and this video is going to go over them in short order. So traditionally, what has occurred is banks want to see 2 years of tax returns as a business owner, and they are going to look at your net income number, not the gross, but the net income number. So after all the write-offs, all the expenses are applied, that bottom number on your tax return, they are going to average that out by 2 years, and that will be the income. The problem is for many business owners that take advantage of all of the eligible write-offs is that's not a very big number, and it greatly reduces your buying power or how much you can get approved for on a home purchase. Fast forward to the last couple of years, there has been a tremendous amount of momentum with alternative products specifically for business owners, meaning alternative ways that we can calculate your income that give substantially more buying power, more flexibility, and are much, much better for the overall self-employed market. The most commonly used one is going to be business bank statement financing, where we take your last 12 or 24 months, usually 12 months is plenty, and we are able to use all of the deposits over those last 12 months and divide them by 12 to get a monthly income average or monthly deposit average that is then used as your business income. An expense ratio has to be applied of anywhere between 10 and 50%. So we do have to haircut that income a bit. The expense ratio is determined by the type of business that you're in and the number of employees that you have. But once we apply that expense ratio, that is your income. Well, this has produced substantially higher approval amounts and much more buying power because there's not as many write-offs through those business bank statements as there are on the tax returns. One of the issues was when these products first came out is rates were a lot higher on these flexible products. There was anywhere from a full percentage point, in some cases 1.5% higher rate than these tax return loans. So it was kind of a difficult pill to swallow. Well, in the last year and a half, 2 years, we have seen rates even out to the point where there is virtually no advantage to using tax returns to get a better interest rate. They price out almost identical. In some cases, we've seen bank statement loans price out better than a tax return loan, just depending on the market appetite and what some of these products are looking to do. This is a massive, massive win and something every business owner should know. This allows for bigger primary residence purchases. If you wanted to get into flips, rental properties, it really opens up the door and has opened up the door for a ton of our clients. And now that rates are ultra competitive, it does a lot for the self-employed community. I want to show a quick visual so you can see just how this works and what that buying power would look like. In your field, you're free to mess around with this particular calculator as it really simplifies things and how this all works. All right, so as you can see on this calculator, we have a few very simple fields here. For the sake of this example, we will say that the business owner is making $530,000 in annual gross income. Right below here, you can see the expense ratio. We will leave this at 50%. That is traditionally the default number that you're going to be allowed to use no matter what. But again, if you are in the service industry, or let's say you have only 3 employees, you may be able to have this reduced to 30%. For individual employees that are, let's say, in real estate, we can oftentimes go as low as 15%. And then there's some unique examples where we can go as low as 10%. But 15 to 50 is really the general assumption. If you have more questions on this, we're happy to contribute to that. And then if you wanted to put in other debt payments here as a monthly estimate, let's say it's $2,700. Down payment, 15% is doable. However, we can go to 20% in this example. And then we'll say it's at 6.5% rate. Well, you can see right here, just based off of these numbers, the buying power is just north of $2.5 million. This is the monthly income that we're able to use in this example. Monthly housing budget would be $16,000 or less. estimated loan amount of $2 million, and down payment needed of $500,000. And this again creates a ton of flexibility that tax returns just simply does not allow for. And we've seen a lot of different examples in this. Even if you were to reduce this down to 260,000, or we'll say 230,000, and a down payment of 15%, and voila, you have your buying power of 822. Let's just say the expenses are only 800 here. Now we're at 1.1 in estimated buying power. This is as simple as it gets. This is how it works. They're very, very robust products. Knowing them is very important. We specialize in these, but again, it opens up the buying power in a tremendous, tremendous way for business owners, and being able to ditch their tax returns that typically do not help the situation at all. So in summary, there's a lot of flexibility for business owners. Other products that I haven't mentioned include profit and loss loans, where we just simply look at a profit and loss statement. Those do have to be prepared by an accountant, but that is another commonly used option. Loans that require no income, simply assets to cover the loan amount. There's a lot of flexibility for different scenarios. If you want to know your expense ratio, what that would look like, exactly what the buying power is, it is a very painless process to get to that point. But the truth of the matter is, there are a lot of different custom tailored options for business owners. We have seen clients not only purchase their primary residence of choice, but also go about and start getting involved maybe in fix and flips or acquired rental properties. All of that becomes much more doable when you're not limited just by your tax return income. I think it's very important to know this. As a fellow business owner, obviously there's always opportunities that we're looking for, but most importantly, to just not be restrained by traditional income methods is the most important topic and point we wanted to make in this video. If you have questions, if you want to talk about any scenarios, we make it very open and comforting to do so. You don't have to be ready to purchase a house, but if you want to know more in what your situation looks like when it comes to these topics, we're happy to talk to you. Thanks, and we'll talk to you soon.